Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if the numbers are hiding more than they're telling us this quarter. Today we're diving into SanDisk's Corporation's latest report, a look at their finances and operations. Get ready because this filing is packed with details about a company that has been through a major change recently. If you want to understand the real story behind the corporate jargon, stick around. And hey, if you like getting these kinds of breakdowns without the fluff, make sure you hit that subscribe button and join our Discord community linked in the description below. It is where we dig even deeper. SanDisk, as you probably know, is all about data storage. Think flash memory, the stuff in your phone, camera, and all those high-tech gadgets. This report covers their financial progress as a newly independent company, which is a big deal because up until February of 2025, they were part of Western Digital or WDC. Let's jump right into the numbers. Looking at their balance sheet as of the 3rd of October 2025, SanDisk had total assets of about $12.7 billion. On the flip side, their total liabilities were around $3.3 billion. This means they have more assets than debts, which is generally a good sign. Their current assets, the things they can easily turn into cash within a year, were close to $5 billion. This includes cash, accounts receivable, and inventory. On the other side, their current liabilities, the debts they owe within a year, were about $1.5 billion. That means they have enough short-term assets to cover their short-term debts. Now, one interesting number here is goodwill, which was almost $5 billion. Goodwill often appears when a company buys another company for more than the value of its identifiable assets. It is essentially the premium paid. Moving on to how they've been performing, their income statement shows us their revenue and profits. For the 3 months ending the 3rd of October 2025, SanDisk brought in $2.3 billion in revenue. That is a solid jump of 23% compared to the same period last year. This increase is largely thanks to selling more of their data storage products, about 31% more in terms of storage capacity, or exabytes as they call it. However, the price they're getting per gigabyte has actually gone down by 9%. So while they're selling more, they're getting paid a bit less for each unit. Their gross profit, which is the money left after subtracting the direct costs of making their products, was $687 million. That is a slight drop of 5% from the previous year, mostly because while they sold more, their costs per gigabyte also increased. Plus, they had some charges related to not using their manufacturing capacity to its fullest, which hurt profits a bit. Their operating income, the profit they make from their core business operations, was $176 million. This is a significant decrease of 40% compared to the same period last year. This drop is mainly due to higher operating expenses. Research and development expenses went up about 12%, partly because of increased compensation and investments in new projects. Selling, general, and administrative expenses, which cover things like marketing and management, also shot up by 38%. This was for a few reasons, including higher compensation, more stock-based pay, and increased marketing costs. They also recorded a $10 million loss on a business divestiture. That's essentially them taking a hit on selling off a part of their business. And their income tax expense was $12 million, a big drop from $56 million last year. This lower tax expense, along with the revenue increase, helped boost their net income. Net income for the quarter was $112 million, though this is a decrease of 47% compared to the $211 million they made in the prior year. It shows that even with more sales, the rising costs and operating expenses ate into their profits. Looking at where the money comes from, their edge market, which includes things like personal computers and mobile devices, saw a 30% revenue increase. Their consumer market also grew by 27%. However, their data center revenue actually decreased by 10%. This suggests that while consumers and other devices are driving growth, the demand from large data centers might be a bit softer, or at least not growing as fast. Geographically, Asia is a big driver of their revenue, up 31%. This is likely due to strong performance in their edge products there. The Americas and Europe also saw changes, but Asia is clearly leading the charge. Now let's talk about cash. Cash flow is crucial because it shows how much actual money a company is bringing in and spending. For the 3 months ending the 3rd of October 2025, SanDisk generated $488 million from their operating activities. This is a massive turnaround from the previous year when they used $131 million. This big positive swing is a strong indicator that their core business operations are churning out cash. They used $15 million in investing activities. This is mainly for buying new equipment and property. Financing activities show a net cash outflow of $515 million. This is largely because they paid down $500 million of their debt. Their cash conversion cycle, which is how long it takes to turn inventory into cash, has improved significantly. It was 113 days compared to 162 days the previous year. This means they are getting cash from their sales much faster, which is excellent for liquidity. Looking at shareholder equity, it increased from over $9.2 billion to over $9.3 billion. This growth is mainly due to their net income. Their additional paid-in capital, which represents the money investors paid above the par value of the stock, stands at over $11.2 billion. They still have an accumulated deficit of over $1.6 billion, which means that historically their expenses have exceeded their revenues. This is not uncommon for companies that are growing and investing heavily, especially after a significant separation. What's really important to understand here is that SanDisk is now an independent company. The spin-off from Western Digital was finalized in February 2025. This means the numbers from that point on are their own, not part of a larger corporate structure. Before that, their financials were essentially carved out from WDC's. This separation also came with new debt and agreements. Speaking of debt, they took on a $2 billion term loan facility and a $1.5 billion revolving credit facility around the time of the separation. They used a good chunk of that term loan to make a $1.5 billion payment back to WDC. As of the 3rd of October 2025, they had $1.4 billion outstanding on that term loan. This is a variable interest rate loan, meaning the interest they pay can change. A 1% rise in that rate would add about $14 million to their annual interest costs. A significant part of SanDisk's business involves joint ventures, particularly with Kioxia Corporation, forming what they call flash ventures. They buy a lot of wafer components from these ventures. They have over $600 million in notes receivable and investments tied up in these flash ventures. They also have some significant guarantee obligations on leases related to these ventures. Totaling over $1 billion, these ventures are crucial for their supply chain, but also represent a substantial financial commitment. As part of their business operations, they sold 80% of their interest in SanDisk Semiconductor Shanghai Company Limited to JSET. This transaction brought in cash and created a venture for assembly and testing. They recorded a gain on this sale. They still hold a 20% interest, which they account for as an investment. They also gained a stake in the Eunice venture, which sells their products in China. This venture is now accounted for using the equity method, meaning SanDisk books its share of the venture's profits and losses. SanDisk has significant commitments for future payments related to operating leases totaling over $300 million. They also have long-term purchase commitments with suppliers amounting to nearly $2.5 billion. These are important to keep in mind for their future liquidity. Looking at the broader picture, SanDisk is seeing strong demand for its NAND flash products. Driven partly by the growth of artificial intelligence, or AI, they see demand continuing to outpace supply through 2026. This is a positive outlook, but they are also mindful of potential impacts from trade policies and tariffs, particularly in the US. They do engage in hedging activities to manage risks from currency fluctuations, primarily foreign exchange contracts. A hypothetical 10% adverse movement in foreign currency exchange rates could impact their fair value by about $56 million. Now, for my take on all of this, SanDisk has successfully navigated a major corporate separation and is now operating as an independent entity. They've shown strong revenue growth and a significant improvement in cash flow from operations, which is a really positive sign. Their ability to increase sales volume, even with slightly lower average selling prices, speaks to strong market demand for their products, especially with the surge in AI driving needs for high-performance storage. However, there are clear areas to watch. The increase in operating expenses, particularly in selling, general, and administrative costs, needs to be managed closely to ensure it does not outpace revenue growth. The large amount of goodwill also indicates that a significant portion of their market value is tied to past acquisitions, so future performance is really about executing their current strategy rather than inorganic growth. Their substantial commitments to flash ventures and other suppliers, while necessary for their supply chain, represent significant future obligations that need careful management. The company appears to be positioning itself well to capitalize on the AI trend, which is a smart move given its core business. The key will be balancing investment in innovation and market expansion with cost control and efficient operations. The improved cash conversion cycle is a testament to their operational efficiency, but the rising cost of revenue needs further scrutiny. In conclusion, SanDisk is a company in transition with clear strength in product demand and operational cash generation. They have opportunities tied to major tech trends like AI, but also face risks related to cost management, competitive pricing, and significant supplier commitments. It will be interesting to see how they manage these factors moving forward. Alright, that's our deep dive into SanDisk's latest report. What do you think about these numbers and what they signal for the company's future? Let us know your thoughts in the comments below. If you found this analysis helpful, please hit that like button to support the channel, and be sure to subscribe for more of these financial deep dives, and don't forget to join our community on Discord, link in the description. Thanks for watching, and we'll see you in the next one.